Welcome to CatEye US Stock. We watch markets with calm focus and sharp instincts. It's Wednesday, January 21st, 2026. Wall Street just ripped higher. All three majors, the S&P 500, the Nasdaq, and the Dow, snapped back roughly 1.2%, clawing back much of yesterday's Greenland sell-off. The trigger wasn't data. It was politics. President Trump explicitly rejected using force in Greenland and pulled back his NATO-targeted tariff threats. That yanked the immediate tail risk off the table and forced traders to reprice a worst-case scenario. But this wasn't a carefree melt-up. Semis, cyclicals, and energy roared. At the same time, gold stayed pinned near record highs, and rate-sensitive corners lagged. So the headline is relief. The subtext? Big money still hedged for a volatile year. Look at the S&P 500 heat map, and you can see the relief. Most of the board's glowing green, with only a few sharp red holds standing out. Semiconductors are the brightest cluster. Nvidia, AMD, Micron, and peers lighting up in saturated green. Healthcare is another sea of strength, led by Eli Lilly and United Health. Industrials flash green across heavy machinery, with Caterpillar among the standouts. Energy majors like Exxon and Chevron are firmly positive, reinforcing the pro-cyclical tone. Against that, the red is concentrated, not random. Microsoft and Oracle show up as deep red bricks inside an otherwise bullish tech block, while Netflix bleeds in communication services. Staples, utilities, and big banks sit more flat and faded. The visual tells the story. Strong breadth, but very intentional exceptions. That heat map rolls straight into the money flow story. Once the Greenland tariff threat was shelved, investors moved fast. Capital rushed back into cyclicals and high beta growth. Semiconductors at the center, industrials and healthcare close behind, and energy riding both growth optimism and a real-world supply shock in natural gas. Small caps jumped roughly 2%, a classic sign that traders were willing to move down the cap spectrum and lean into economic sensitivity. Where did the money come from? Out of the crowded defensives and some mega-cap software. Microsoft and Oracle were sold hard. Staples and utilities lagged. Banks stayed mostly on the sidelines. Add in record-level energy prices and a gold market that refused to back down, and you get a dual-track tape. AI hardware and real economy leverage ripping, inflation hedges still firmly in demand. So what does this breadth and rotation actually mean? On the surface, Wednesday looks like a clean, policy-driven reset. Indexes bounce, volatility backs off, defensive positioning gets trimmed, but the internal mix is less relaxed. Even as equities rally, gold hovers near record highs, signaling that institutions haven't unwound their hedges. The energy complex hits fresh highs, not just on geopolitics, but on a violent spike in U.S. natural gas futures over the past 2 days, tied to an Arctic freeze. And interest rate-sensitive sectors still lag, while the 10-year Treasury yield sits above 4%. Put together, this feels less like problem solved and more like tail risk reduced, volatility here to stay. Risk is back on the table, but nobody's taking off their seatbelt. Around trading desks, the big debate is where the real AI risk lives. Unconfirmed chatter today kept circling the same themes. That the street is quietly souring on smaller AI software and analytics names, even as it chases the big chip makers. That some funds see balance sheet risk and contract uncertainty in the more speculative names, and are treating any pop as a chance to sell. You also hear crypto products like GBTC mentioned as fragile barometers. When those vehicles wobble on ETF outflows, some desks read it as a warning about the outer edges of risk appetite. These are rumors, not hard data. But they frame a key tension. Is today's AI trade about durable infrastructure, or just the latest batch of story stocks? U.S. equities staged a sharp rebound today after President Trump paused earlier tariff threats tied to Greenland, easing a key policy overhang that had pressured markets. Wall Street responded with a clear U-turn in sentiment. The dollar weakened, volatility rolled over, and stocks rallied broadly. This move wasn't driven by new economic data or earnings surprises. It was policy relief. Markets had been pricing in escalation risk, and today's pullback forced a repricing of that fear. Importantly, the sharp drop in the VIX suggests defensive positioning was unwound, not replaced by complacency. The takeaway is straightforward. This market remains highly sensitive to trade headlines, and leadership stability, not rhetoric, will determine whether today's rebound has follow-through. Washington is escalating the fight over artificial intelligence and national security. A key House committee has approved bipartisan legislation that would give Congress direct oversight of advanced AI chip sales to China. The bill would also ban Nvidia's next-generation Blackwell chips from China for at least 2 years, turning existing export controls into law. This move directly challenges the Trump administration, which recently approved Nvidia's H200 chip sales to Chinese customers, arguing that U.S. technology dominance is strengthened through global adoption. Lawmakers from both parties disagree. They warn that exporting advanced AI chips could accelerate China's military and economic capabilities, putting America's technological edge at risk. The bill now heads to the House floor, with similar efforts emerging in the Senate, setting the stage for a high-stakes clash between Congress, the White House, and Silicon Valley. The U.S. housing market is showing fresh signs of strain. Pending home sales fell sharply in December, with contract signings dropping more than 9% month over month. That decline came despite lower mortgage rates, raising doubts about the durability of the housing recovery. According to the National Association of Realtors, contract activity fell in every region of the country, led by a steep drop in the Midwest. Compared with a year ago, signings are still down nationwide. Economists point to limited inventory as a key factor. December listings fell to just over 1 million homes, among the lowest levels of last year, leaving buyers with fewer choices. With 2024 and 2025 tied as the slowest home sales years in 3 decades, the coming months will be critical in determining whether this slowdown is temporary or a deeper trend. Let's start the stock deep dive with Microsoft. Microsoft fell more than 2% today, even as the broader market ripped higher. Traders pointed to rising AI infrastructure costs, mounting regulatory scrutiny, and plain valuation fatigue. On the charts, the stock broke through a second layer of support, a move that caught a lot of eyes on the desk. Why it matters. Microsoft is one of the biggest weights in the S&P and the Nasdaq and a core AI bellwether. Seeing it trade red in a green tape is a clear signal that some money's rotating out of crowded megacap software and rethinking how to express the AI theme. On the flip side of that rotation is AMD. Advanced Micro Devices ripped almost 8%, one of the strongest moves in an already hot semiconductor group. Flows chased exposure to GPUs and AI accelerators ahead of upcoming earnings, with commentary highlighting strong demand visibility and AMD's role as a key challenger to Nvidia in data center AI. For traders, AMD has become a high beta way to express the AI infrastructure story. Its move didn't just lift the stock, it added real juice to the Nasdaq's rebound and reinforced the idea that the AI build-out isn't a one-vendor game. Micron was another big winner in the AI lane. The stock surged more than 6% as traders leaned back into the AI memory story. Recent price target hikes and the idea that Micron sits at the heart of the memory cycle for AI servers outweighed fresh warnings that the good news might already be priced in. In practice, Micron has become a barometer for how confident the market is in AI infrastructure CapEx. The willingness to chase it higher today, even after a strong run, says investors still see room in the memory trade, at least for now. You can't talk about today's move without Nvidia. Nvidia traded sharply higher alongside the broader chip complex as relief over European tariff risk allowed investors to re-embrace the sector's flagship AI hardware name. Bullish commentary around its dominant position in accelerators and data center GPUs stayed intact. Nvidia is still the emotional center of the AI trade. Its bright green tile on the Heatmap amplified the risk-on tone and gave traders confidence to lean back into AI infrastructure after Tuesday's macro-driven shakeout. Outside of tech, Eli Lilly was a key driver in healthcare. The stock climbed more than 3% after fresh positive news on its obesity and weight loss pipeline, including an FDA green light for a pill candidate and bullish write-ups on its rivalry with Novo Nordisk. Lilly has become the market's default way to play the obesity drug theme. Its strength not only lifted healthcare as a sector, it also underscored a broader point. Investors are still willing to pay up for clear, structural growth stories, even as they sell down some software names. In industrials, Caterpillar told you plenty about the macro tone. The stock was a bright green standout as traders rotated back into heavy machinery once Greenland-linked tariff fears eased. Caterpillar is a classic cyclical bellwether, often treated as a proxy for global infrastructure and industrial demand. Its strength, alongside other industrial names, helped power the Dow and reinforce the idea that Tuesday's sell-off was more about policy shock than a fundamental growth break. Tesla was another important tell on risk appetite. Despite recent volatility, the stock traded higher into its January 28th earnings date, with bulls leaning on research that frames the upcoming print as potentially better than feared. The story still blends electric vehicles, AI, full self-driving, and robotics. Tesla remains a critical barometer for retail and speculative capital. Its resilience in a choppy macro week suggests that, with policy risk dialing down for the moment, there's still plenty of appetite for high beta growth when the narrative's big enough. Finally, a quick look at the edges of the risk spectrum through SLV and GBTC. Silver, via the SLV ETF, fell about 2% after a powerful recent run as some safe haven and inflation hedge interest bled out on the back of today's equity surge. Crypto-linked GBTC likely traded softer as well, with notable outflows from Bitcoin and Ether ETFs weighing on sentiment. That underperformance, even as stocks rallied, suggests investors aren't blindly re-embracing all forms of high beta risk at once. The bid is selective. Hardware over hype, infrastructure over pure speculation. So where does this leave us heading into tomorrow? The immediate calendar is light, which means the tape stays sensitive to headlines and positioning rather than fresh data. But the road ahead is busy. Next week brings durable goods and consumer confidence, followed by a key Fed decision and Chair Powell's press conference. Tesla reports on the 28th, with Microsoft's earnings window closed behind. Put differently, today answered one question. No sudden Greenland tariff shock, but left plenty unresolved. Can AI and EV leaders defend rich multiples? How does the Fed frame the path for 2026? And does this new leadership mix in chips, energy, and healthcare stick when the next wave of data hits? To wrap up, today was a textbook policy reprieve, but not a clean slate. Equities bounced hard as Greenland-linked tariff risk faded, and leadership clearly shifted toward AI chips, industrials, energy, and healthcare. At the same time, gold stayed near records and the energy complex pushed to new highs, telling you that big money still sees volatility as a feature of 2026, not a bug. For now, the market is risk-on, but hedged. The next chapter will be written by earnings from names like Tesla and Microsoft, and by the Fed's tone next week. We'll be watching how this new leadership holds up when the next headline hits. Thank you for watching CatEye US Stock. Stay curious, stay calm, and we'll see you next time.